Good afternoon and welcome to today's session of Profitability and Loan Pricing Strategies for the COVID-19 credit environment. This is a presentation of the Ohio Bankers League's annual meeting in 2020, occurring on November 5th and 6th. My name is Jeff Morris and I'll be your presenter today. I'm Managing Director at ProBank Austin and it's a pleasure for me to be with you today. Quick run through of the agenda we're going to be covering. We're going to provide some background on industry profit trends, including factors causing a rapid decline in banking industry profits, as well as some of the factors offsetting that decline, mostly due to COVID-19 circumstances. And then we're going to get into the bulk of the presentation, which is about pricing strategies in response. So to jump into it quickly, as you may or may not be aware, the banking industry has experienced a significant decline in profitability in the first 6 and first 9 months of 2020, falling from about $221 billion of profit in last year's 2019 performance to just under $72 billion in profit in the first 6 months annualized for 2020. That's a 68% decline. The impact that decline has had on returns and return on assets is similarly significant. A drop from about a 121 median ROA down to 70 basis points. That is the median performance. The aggregate performance of the industry as a whole was slightly better in 2019 and is significantly worse in 2020 due to the effect of the largest banks in the country having an oversized impact. 129 was the industry aggregate ROA for 2019. It's down at 37 basis points is the estimate for 2020 at this point in time. And again, a similar impact on return on equity from 996 for the median down to 591, and for the industry aggregate from 1105 all the way down to 347. So some pretty stark changes there. If we break that out and look at it by institution size, what we'll notice is that the 68% decline that occurred to the industry overall was felt to an even greater degree by the largest institutions in the country. And here I'm looking at institutions 10 billion and over in total assets, experiencing a 77% decline in net income, while community banks experienced a lesser decline from 33 billion down to 28 billion, a 16% decrease. So impacting the largest banks to a greater degree than community banks. Let's look at the income statement broken out line item by line item, and to see what's really driving that. The 68% decline equates to a $149 billion decrease in net income. And that's being driven primarily by a $170 billion increase in provision for credit losses. It might be important to note that the industry as a whole is doing pretty well in maintaining net interest income, where during this time period, interest incomes dropped 53 billion, but interest expenses have dropped by 54 billion. So we actually have a small, very, very small increase in net interest income. But most of the issue is really all related to an increase in the provision for credit loss. If we look at that for the largest banks, again, the situation is true. The 77% decline equating to 144 billion of decrease in net income is more than 100% caused by a $162 billion decrease. $162 billion increase in provision for credit losses And we'll note again that net interest income is maintained within the largest institutions' numbers during this time period. Let's look at how it's affecting community banks. The 16% decline equates to a $5.3 billion decrease in net income. And once again, more than 100% of that change is due to an $8.2 billion increase in provision for credit losses. And once again, net interest income is maintained with interest expenses decreasing by more than the decrease in interest income. So let's look at kind of a long-term picture of the provision for loan loss and its relationship to net charge-offs. Here we're looking at a 15-year time frame from 2005 through second quarter of 2020. And what we'll notice across the entire time frame, which is true for most longer periods of time, most business cycles you would look at and segment, no matter what time frame you might be looking at, as long as you're looking at a full business cycle, provision for loan losses and net charge-offs typically equal one another, as they do in this 15-year time frame. The provision expense in the second quarter of 2020, looking at just the first 6 months compared to prior year annual totals, almost double in the first 6 months of 2020 compared to the full year levels of 2016 through 2019. If we were to annualize that, which I'm going to tell you would not be the appropriate thing to do, we would see $220 billion of annualized provision for loan loss for 2020. We don't want to do that. It wouldn't be appropriate to do that. And the reason for that is primarily the fact that in the first quarter of 2020, about 90 or so of the largest banks in the country implemented a new accounting standard called CECL. I'm sure you're all aware of that. And that is a big factor of what's causing this increase in provision for credit losses, along with an actual underlying change in the credit performance of individual commercial banks' portfolios. Might draw your attention to an article that ProBank Austin released back in July of this year. The article's called "What Can Community Bankers Learn from Large Bank CECL Disclosures?" And what we did here is we analyzed just the big four U.S. banks, JP Morgan Chase through Citibank, the four largest institutions in the country, and we were able to break out the impact of their one-time CECL transition cost versus what I'm calling their ongoing credit trend. And what we find as a result of doing that, even with Wells Fargo being kind of an outlier within the group of the big four, Wells Fargo recorded a release in reserves as a result of transitioning to CECL, a $1.3 billion decrease at the point of CECL implementation. Even with their numbers in the mix, almost half of what was recorded in the first quarter of 2020 was related to the one-time accounting adjustment transitioning over to the new accounting method of CECL. 43% of $21 billion of provision expense in that first quarter was related to the accounting adjustment. So we will not want to be analyzing those numbers as we look forward. If we look at just the larger banks, that includes the subset of banks that transitioned to CECL in that first quarter, and we tried to annualize their numbers, we'd actually get more provision for credit loss for 2020 than we experienced at the depth of the financial crisis back in 2009. So that would be a very inappropriate way to look at it. We need to adjust our numbers for that as we look forward. What about community banks? What do their provision numbers look like in the first half of this year? Still an increase, but lesser so, $6.4 billion in annualized provision expense. And here I think it is appropriate to annualize the June 30th numbers to get to that $6.4 billion estimate for the year. That's a little bit less than a 50% increase over the $4.6 billion that the community bank industry recorded in 2019. But nevertheless, an increase, but nothing nearly as outstanding as what we see on the larger bank side, because community banks, for the most part, have not adopted CECL at this point in time. So let's shift a little bit and let's understand what's happening with loan portfolio growth within the industry. This is the industry total. And we're looking at the last 3.5 years, from the end of 2016 through the second quarter of 2020, only because third quarter numbers are not fully out yet as of the date of the presentation. Loan portfolio growth has averaged 5%, a little bit less on the 1 to 4 family. Loan type, mainly the banks are deciding to originate and sell those loans at a greater rate than loans being added to their portfolios. That's probably a good situation rather than an unfavorable situation. Most of the other portfolios have been averaging around 5% growth, except for C&I loans. And what we find in the 10.7% growth of C&I loans is the presence of a lot of new PPP loans that have been generated in the second quarter of 2020. So just to be a little bit aware of how the loan portfolio is changing as we move forward. Here we're looking at kind of the differences between the last 3.5 years, from 2016 through the end of the second quarter, versus just the changes in the first 6 months of 2020 versus 2019. Similar overall growth level, 5.4 versus 5.3. So not much difference there, but there is a significant standout difference in the growth of C&I loans. In the short term, that actually is about a 24% increase in C&I loans, mostly as a result of the increase in PPP loans in the second quarter of this year. And let's look for a moment at how the loan growth is different between larger banks versus smaller banks. On an overall basis, smaller banks have seen, community banks have seen their loan portfolios grow by only about 2%, 1.9%. This is over the last 3.5 year period of time. The C&I loans that include the PPP loans have grown 14.5% for community banks, the light blue shaded bar, versus 10.7% for the industry and 9.9% for larger banks with assets over 10 billion. So important for us to understand how those loan portfolios are changing as we go through time. Probably also helpful to understand the market share of loans for smaller banks versus community banks. As of June 30th, 2020, community banks held about 20.3% market share in all loan types across the entire portfolio. Better performance on construction and development loans and on CRE loans, commercial real estate loans. Lesser performance on the all other loan product type at only 12.3% market share. I'm going to suggest that that's not a worry either, because what's in that category is credit card loans and consumer loans, which are profitable to some extent for larger banks, but very difficult to make profitable for community banks. So that's not much of a concern. If we look at how market shares changed over time for community banks, we're down about 2.5% versus where we were at market share wise at the end of 2016. Greater decline in market share in construction and development loans at 6.7% down. 1 to 4 family and CRE loans are down about 3%. And the C&I loans, only really due to the short-term consequences of the addition of the PPP loans, are actually up 2%. So moving from 16.7% market share in 2016 to 18.7% market share in 2020. So this is perhaps an opportunity for community banks. There's been a lot of press over how the larger banks did not necessarily serve the needs of the smaller and middle market customers in their traditional customer group well during the PPP application process. A lot of those customers ended up going to community banks kind of as a new trend, a first time recent trend to get their PPP loan needs met. And for the most part, they were welcomed with open arms. Community banks did a very, very good job, and that provides them with some potential opportunity to serve those middle market and the smaller companies amongst the larger company group. That would be large customers, new large customers for community banks may have an opportunity to serve those customers more in the future. So a quick peek at the trends of interest rates. Back in 2016, Fed funds was running at 50 basis points, coming off of kind of long-term historical lows after the Great Recession. Ramped up through the first quarter of 2019 up into the 2.25% range. We took a couple of rate cuts in middle to late 2019, and then in the beginning of 2020 with the onset of COVID, the Fed funds rate was slashed by 150 basis points, 1.5%, bringing it down to near zero again. And those trends were closely followed by the 3-year and the 5-year treasuries, both of which are pretty good reference rate benchmarks for commercial loan pricing purposes. So just a quick review and a reminder of where those trends are. That's what's bringing such pressure to lowering loan rates in the current environment. Pretty much a similar pattern is observed if we look at the Federal Home Loan Bank rates for 3- and 5-year FHLB advances, about 75 basis points higher at the end of this time frame than the U.S. Treasury rates, where they started out 150 basis points higher at the beginning of this term. But nevertheless, the overall trend is similar. It's downward, and it's putting pressure on interest income for our loan portfolios as well as for our investments. Overall yield trends for commercial bank industry, we topped out loan yields at 5.60 back in the second quarter of 2019, and those have been moving down to 4.40 as of the end of the second quarter 2020. So 120 basis points of decrease in loan yields and 133 basis point decrease in earning asset yields on an overall basis as investment portfolio yields have dropped as well. If we try to understand the difference between earning asset yields and loan yields, it's probably helpful to look at changes in the loan to asset ratio. That has been dropping through the first quarter of 2020 from a peak at the end of 2018. We were at 56, almost 57% loan to asset ratio for the industry in total, down to 51% at the end of the first quarter before COVID-19 really hit hard, and then increased to 53.53 with the addition of PPP loans during the second quarter of 2020. Quick glance at loan yields for individual segments of our portfolio here. I think what we would concentrate on would be the black line at the top, which are C&I loans, and the brown line at the top of this graph, which are other real estate loans. That's a little bit broader category that includes primarily commercial real estate loans along with multifamily loans and C&D loans, those sorts of things. We're seeing the black line for C&I crash And that's probably an overstatement that we just need to be aware of, as the PPP loans came on at a yield of 1%. That sent that number downward in a fashion probably more pronounced than what reality will be at the end of the story of PPP loans, when those are ultimately forgiven by the Treasury and the SBA, and we're able to recognize some of the fee income associated with those back into the yield of that portfolio. The final answer on that number will be a little bit less, but still the overarching trend is a very significant decrease in loan yields for both of those loan types that we're significantly interested in. How is that different for larger banks versus smaller banks? Well, it's very different for community banks. Here I'm looking at just two groups on each side of the breakpoint of 10 billion. The brown bar in this graph is the 10 to 50 billion size banks. We're seeing those at 382 as of the end of 2020 as far as other real estate loan yields go. Significantly higher, but still decreasing rapidly for community banks. And here I'm using as a proxy for community banks just those banks with 500 million to 1 billion in total assets, coming down from 540 in the third quarter of 2019, the recent peak, down to 502 as of the end of the second quarter 2020. Similar information here for C&I loans, 385 for the larger banks, 539 for community banks. And again, we're using the same two size classes here for these C&I loans. These numbers are being affected by the PPP loans at 1%. So before we jump into loan pricing issues, let's think about what our alternative investment rates are if we're not making, because of weak loan demand, because of competition, because of trying to hold our yields on new loans higher than perhaps the current environment will allow. Well, what's the downside of that? Where will that money go to? Where will that money move by way of alternative investments? The options are not very attractive. Fed funds at 9 basis points, treasuries at 20, agency securities at 24, municipal bonds, a fully taxable equivalent yield of 48. A 3% loan looks really good by comparison to some of these alternative investment rates, when a 3% loan is not something we would previously have even thought of putting on our books. Using that as just kind of a proxy for the low end of current market rates, not suggesting that we will actually be making 3% loans, but just showing the differences in the impacts. If we think about what product profitability has to tell us about what portions of our product balance sheet we would want to be pushing at any one point in time to try to grow the ROE of our individual community banks, commercial loans is definitely high on that list. This is information taken from a current profitability client of ProBank Austin's. Product profitability on commercial loans. Traditionally, we know this is a conservative example. 1150 represents about a 20% premium over the 965 of the bank-wide average. That's kind of the low end of the range, and what I would think of as more normal times, we might see something between a 20 and a 60% premium, or an increase in commercial loan profitability in excess of bank-wide profitability. But just to give you a sense of how important that product line is to us, it is really the best lever we have outside of non-maturity deposits and mortgage loans, which kind of run on their own cycle. The mortgage loan ROE is quite high because, one, we're not holding those balances for the most part, and that ROE is being driven by loan fees and gain on sale for loans that are leaving the balance sheet of the bank. And we will continue as an industry, I'm sure, to specialize and promote that product line. But organic growth of the actual balance sheet of loans we hold, the best opportunity here is clearly commercial loans. So 20 to 60% premium on commercial loans is kind of the long-term average. We'll just keep that in mind as we start to look at some of our options. So let's get into talking about the strategies that we think are appropriate for the current point in time. I'm going to use two examples. And we're going to look at a CRE loan and a C&I loan in a few slides. The environment externally that we're looking at is one of very, very weak low demand. Loan demand at 2 to 5% growth is probably somewhat optimistic for the current time frame. We'll call it realistic for now. There is excess liquidity everywhere in the marketplace, even though deposit rates are extremely low. Our alternative investment options, as we already have shown, are not very attractive. And I think an expectation we all carry with us into the future is these low rates that we're experiencing currently are going to remain low for the extended future. So that's kind of the external environment that we're living within. What are our internal requirements? What is it that we must try to match against those external environmental pressures to try to maintain a healthy bottom line, net income, ROA, and ROE? Well, 12 to 15% ROE targets would be what we're shooting for. Particularly here, we're just talking about on the commercial loan portfolio. What would our ROE targets be in like a loan pricing model exercise? Previously, in what would be thought to be more of a normal market, if anyone can remember what that looked like in past history, we would really have been looking at 18 to 22% ROE targets in a loan pricing model exercise. And we've pretty much gone away from that here recently just due to the level of competition in the environment. Credit costs are at this point in time, because of the situation with the economy, meaningfully higher than they have been in the past. They're coming off of historical lows, so we can double, triple, or quadruple the recent historical net charge-off rates or provisioning levels and still be at levels below long-term industry averages. But still, credit costs are something that have to be carefully considered in today's environment. And the suggestion that I'll have for you is that we want to look at those over the entire life of the loan when we're trying to manage the strategies of how we're going to price commercial loans in the current environment. We'll look at loan losses as if we were already under CECL. Good news is operating costs are stable. They're not going up at any remarkable rate during this COVID-19 period of time. But we will be using FHLB as a primary cost of funding curve for our loan pricing analysis, commercial loan pricing strategy settings, primarily because LIBOR's gone away, or going away soon. It's really kind of lost its credibility as a funding base. And the U.S. Treasury curve at its historically low levels and as flat as it is, particularly out through the 3, 5, and 10-year portion of the curve, is really do not want to be using the Treasury curve as a cost of funding basis. In the past, that would be kind of the gold standard or benchmark curve to be using. FHLB is really kind of our only option for loan pricing cost of funding. So here are the two loans we're going to look at, a CRE loan and a commercial line of credit. Just laying out for you here kind of the standard terms that we'll be looking at. I think these are similar to, hopefully, loans that you would commonly make inside your community bank. $750,000 CRE loan fixed for 60 months, amortized over 240. We'll look at the effects of a average credit quality borrower with a 3 credit score. We'll be using the FHLB curve for cost of funding, as I mentioned previously. We'll apply some nominal fees to this. I think fees have pretty much left the market because of the competitive situation between banks today. But we'll apply some nominal fees, a quarter point, plus maybe some origination fees, and we'll apply standard cost in the examples we'll be using coming up here in a moment. On the commercial operating line of credit side, we'll look at a $2 million commitment, which is 50% utilized over the course of its term. We'll assume it's renewable annually, meaning that the bank has every 12 months has another bite at the apple, if you will, for evaluating the creditworthiness of the borrower and determining whether to extend that loan or not. We'll use the FHLB curve again. We will not apply fees to this loan type. Fees are a powerful add to the ROE of line of credit loans. The shorter the term of the loan, the greater the impact of the fees. For this exercise, we decided to leave those fees out. If you can add them, more power to you. That's great. Do it, and then we'll use standard cost assumptions. So let's just review quickly what we looked at earlier in the loan yields for other real estate loans, kind of the pattern or the path that we've been on. We're going to be asking here in the kind of our strategy setting exercise, where is the floor? Every institution across the country has to determine for itself, how low are you willing to go? At what point do you floor your loans and say, as much as we want additional commercial loan volume, we're not going to bring it on to the bank's balance sheet unless we get a minimum loan yield. I've traced some lines here at 4% and at 3.25%, just to suggest perhaps somewhere within that range is where we're heading. Every institution really has to make that call for yourself. As of the end of the second quarter 2020, the industry as a whole for other real estate loans, the community bank industry as a whole is at 4.11 for this loan type. So with that, let's start to evaluate some loans that fall in that category. Here's our $750,000 commercial real estate owner-occupied loan. If we're willing to price that at the low end of our ROE target range, I'm calling that 1250, with a desired, a more preferred ROE target at 15%, how would we price that loan? We're using the FHLB borrowing rate as the cost of funding, 60-month fixed rate term, 240-month amortization, to get that $750,000 loan for an average credit quality borrower to 12.5%. We can actually price that as low as 366. Okay, so I'm showing you here the analysis, the ROE analysis of that as presented by Loan Pricing Pro, the commercial loan pricing software provided by ProBank Austin. So 366 is kind of a starting point rate for that loan. How do we get those numbers? Okay, one of the key elements is the cost of funding. We're using the FHLB borrowing rate curve to determine the cost of funding. The 60-month FHLB rate is 85 basis points, but we're going to use the cash flow method and looking at the principal payments of the first 59 months and factor that into the overall cost of funding. That brings it down by a couple of basis points. So we'd be looking at 83 basis points as the true all-in cost of funding that loan over the first 60 months of its life. If we price it at 366 with an 83 basis point cost of funding, the net interest income or the net interest margin on that loan is going to be 283. So just so we sort of understand the profitability dynamics behind this analysis. If we want to go to the other end of our ROE target range, if we want to earn 15% on this loan, we essentially have to price it at 4%. So that's just 11 basis points below where the industry was at for this product type as of the end of June 4.11. So 4% will give us a 15% ROE, where 366 will give us a 1250 ROE. That kind of provides the beginning endpoints of a range of pricing that you might deem to be reasonable. Well, what happens if we're dealing with a customer that has some significant deposit relationships with us? Here's a customer, this is an actual live customer taken from a live client. $67,000 in non-interest-bearing checking, added to or enhanced by $113,000 of money market. Long-term average balances held with the bank, that's significant self-funding of the loan, if you will. 66% ROE on that $180,000 worth of deposit balances. Just adding those accounts into the prior analysis at a 15% ROE brings the ROE of the customer relationship up to 1755. Most people would love to have that, but most people would be willing to price off of that as well. So if I ask Loan Pricing Pro to tell me, how many basis points in loan yield does that $180,000 deposit relationship give the customer, it's a 12 to 13 basis point decrease in the rate on their loan. We can price the loan based on the presence of those deposit balances. We can price the loan at 387. 12 to 13 basis points below the customer that doesn't have those balances. We'll bring our product mix adjusted ROE target to 16.65, and that would be kind of a good basis of comparison. The loan itself will be less than the 15% desired ROE. It'll be at 1405, but the relationship as a whole would meet our profit target standards. So 13 basis points decrease in loan price due to a $180,000 deposit relationship. What if we are willing to price down to the minimum end of our ROE target range? We'll bring the ROE target on an overall basis down to 1420, which I think many banks are willing to do today, willing to take this relationship at a 1420 ROE. That brings the pricing down further to 353. So about a 30 basis point reduction, again, as a result of lowering our standards to the minimum end of the desired ROE range. Well, what if this customer is actually not average credit quality? What if they're actually excellent credit quality? If that's true, we can lower the expectation of loan loss, and the price on the loan falls further to 338. So just trying to demonstrate for you a little bit, what I think the competition is doing out there with respect to pricing of commercial loans in the existing environment by using these examples, kind of walking through the impacts of, what is the implication of our choice of ROE target, whether we're aiming high or aiming low, 12.5 or versus 15. What's the impact of other product profitability, like prior existing deposit relationships, and the credit risk-based pricing piece of this? What's the difference in loan yield that an excellent credit quality of 1 customer earns versus an average credit quality customer, say a 3 or a 4. And this is basically the way that we would use the model to answer the question, how low can you go in a current situation, and where should the floor be, and how would we determine what that floor is? Best to be able to use a loan pricing tool like Loan Pricing Pro to accurately and objectively analyze these impacts. What if we went further and said, okay, we don't need 14% on the relationship. All we care about is 12.5% on the relationship, understanding that the relationship in this case still includes $180,000 of deposits, which have much higher ROE as a result of lower capital allocations to deposit products. You can get all the way down to 314, a little bit below, 1/8 of a point essentially below prime. this current point in time, but we would only do that for an excellent credit quality customer. So just a little bit more on, the thinking that we're seeing out there in this very, very competitive environment. If you're a bank that's at 8 or 9% ROE on a bank-wide basis, and you're happy with 12.5% ROE on a combined customer relationship profitability basis, which includes some deposits, 314 is the way you just 314 is a rate that you can justify with that overall relationship. So we'll walk through quickly similar dynamics for C&I loans, which is where our PPP loans are currently. Same question being asked, where's the floor on C&I loans? The floor is probably a little bit lower. Here I've traced my top and bottom of the range at 375 and all the way down to 275. Well, as I said before, every bank makes those calls on their own, including the presence of PPP loans in this portfolio. As of the end of the second quarter 2020, yields had fallen from 442 down to 360. That is I don't want to call it an aberration, but it's an unusual event due to the presence of those 1% PPP loans, which is not the final yield on those loans. It will be higher than that. So this floor needs to stay probably closer to the higher end of the range here, 375, 350, 3.25, maybe even. As I said before, every bank determines that for themselves. But let's just walk through a couple of similar examples here for the commercial line of credit loan. If we're shooting for the full 15%, the desired end, the higher end of our ROE target range, this loan has to be priced at 408 to give a 15% ROE to an average borrower. Again, here the cost of funding is going to be based on the FHLB curve, but because this is an overnight repriceable loan, interest only during the term of 12 months, 24 months, perhaps in longer situations, 9 basis points is our current cost of funding, coming from the short end of the curve, highly impacted by the Fed funds rate near zero. If we allow our profit expectation, our ROE expectation, to fall to the lower end of the range, 12.5% ROE, we can price that down below 4, we can get all the way down to 368. That's for an average credit quality borrower with no deposits. If we adjust credit quality up to excellent, if that's actually the case for your specific customer that you would be working with, a 12.5% ROE is produced with a rate equal to prime, 3.25. If we bring the relationship that we talked about before, $180,000 of deposits in a mix of non-interest bearing and money market balances, we bring that into the relationship, it takes the 12.5% ROE up to 13.97 and enables pricing for the average borrower to come down to 387. I'm sorry. And so just to allow you to see some of the impacts of loan pricing model analysis on your pricing of your commercial loans in the current environment, which is extremely difficult given weak loan demand, extremely low rates, very high competition. So maybe we'll just kind of close out with a few comments about the use of loan pricing models for these purposes, for determining the strategies of your loan pricing. The traditional purpose of a loan pricing model in normal times, if you can remember back that far into history, is that you're always looking to, how do we add profitability to the relationship? What combination of additional fees, shorter term, higher rate, more deposits, each of those individual elements can add a few basis points here and there of total ROE level profitability to the overall customer relationship. And doing that on every deal you do means millions of dollars to your bottom line. That's kind of the traditional use of loan pricing model tools. The use that we've been seeing much more frequently in current times is really the opposite direction. How low can we go in pricing and still meet the profit expectations of the bank? Now, the loan pricing model appropriately calibrated for your individual bank can help you to determine quite accurately what that bottom line number is. Hopefully, in most situations, you don't have to go all the way to that bottom line number. Try to stay away from that. Go as low as you can in the direction of that number and still secure the relationship with the customer, but don't necessarily go all the way to the bottom. But it helps to know where the bottom is, and it helps to know where your walkaway point is. Loan pricing models will help you determine how many basis points of yield differential should exist between customers with different credit grades, the 1 versus the 3 versus the 4. 15 basis points, 30 basis points, what is it? The loan pricing model will help you answer that. How many additional basis points or how many fewer basis points of yield would a customer pay based on the profitability of their entire relationship with additional prior existing loans or deposit relationships that are profitable? Not all deposit relationships are in fact profitable, so you kind of figure out what's the impact of each deposit type. How many basis points of yield decrease is that worth? And from an overall standpoint, what you're really trying to do is manage the portfolio level return, not only of your loan portfolio as it's in its entirety, but individual products, C&D loans, C&I loans, CRE loans, each of those, as well as within individual officer portfolios, you can manage at each of those levels. So because of the virtual nature of today's presentation, I'm not able to answer your questions here, but I will make the commitment to you that if you send me questions on today's presentation, I will be happy to follow up with you virtually via email. You can reach me at jmorris@probank.com, or you can reach my partner, Andy Morgan, same place. Or if you're on our website looking at Loan Pricing Pro, feel free to communicate with us from Loan Pricing Pro at ProBank.com. So I'm sorry that I'm not able to answer your questions live and in person today, but I look forward to answering those for you in the future. Thank you for being part of today's presentation and this year's OBL virtual annual meeting, and wish you the best of success in coping with the COVID-19 crisis, and hope that everyone has a great recovery coming up here in the fourth quarter of 2020. And we look forward to chatting with you at OBL events in the future. Thank you for attending today's presentation.